Very good morning everyone. Sorry. Very good afternoon everyone. How are you all? कैसे हैं आप सब? First, can you let me know that video, audio, everything is clear? Audio, video, सब fine है? Everything is fine? Then we can start today the live session for the top 95 questions. And today, of course, we'll cover two major chapters, that is consolidation and business combination. बताइए, everything is fine? We'll wait for 1 or 2 minutes, then we'll start. Yes, Padma, good evening. Mansi, good evening. BRSK, good evening. एक बार फटाफट बता दीजिए, सब चीज क्लियर है? एक बार सब अपना अटेंडेंस दे दीजिए. फर्स्ट, everyone just give your attendance, then we can proceed. Guru Teja, good evening. So today, let me say you something about our journalism. Today is our Daslakshan Parva is started, and today is the first day, and we call it Uttam Chama. What is Uttam Chama? Uttam Chama says that we as a human being should have peace, truth, and discipline in our life. Means what Uttam Chama says that we should always try to forgive others, so that our mind should not be heavy, and we should not think about unnecessary thing much, because once you forgive others, then what happen, our mind become relaxed. Normally what happen in our student life also, sometime what happens, something happen in our life. For example, some of your friend will say something to you, or it is quite possible that ICAI has not given marks in one or two questions in the last attempt, and we think a lot of about that. So what our Jainism says that we should forgive others, so that if once you forgive, that point will not come in your mind, and you will try to focus on future, you will not try to focus on past. And that today the day Uttam Chama says, correct? So okay, we should start from this particular thing today, ki we will try to forgive others for whatever thing they have done in our life, and we'll start our journey as if that we do not have anything in our mind. Got this point? Yes, sir. So today we'll start with Ind AS 110, consolidation, Ind AS 110, and the first question is what? Question number 24. So let us come to question number 24. What is question number 24? I hope you have already downloaded these expected questions. So question 24, good question, already asked in exam. This question have been asked in exam. What this question says, let us see. On 1st April 2017, A Limited acquired 80% of share capital of S Limited. Okay. On acquisition date, the share capital and reserve and surplus stood at 5 lakh and 1,25,000 respectively. So they have given the share capital and reserve and surplus on the date of acquisition. A Limited paid initial cash consideration of 10 lakh to initial cash consideration has been paid. So this is nothing but a part of purchase consideration. Yes, sir. Additionally, A Limited issued 2 lakh equity shares with a nominal value of 1 per share at a current market value of 1.8 per share. This is also a part of purchase consideration only. It was also agreed that A Limited would pay a further sum of 5 lakh after 3 years. So this is also a part of PC, which is nothing but deferred consideration. And deferred consideration we recognize at present value as on today. Okay. So A Limited cost of capital is given 10%. The appropriate discount factor for 10% receivable at the end, first year, second year, third year, they have given. Now I just want to ask one question. You need to find out the present value of deferred consideration. So what we should do? My question to you all, we should do 5 lakh into 0.75. We should do 5 lakh into 0.91 plus 0.83 plus 0.75. Which one is correct? Fast. Everyone respond, because I know normally students do mistake at this point only. So when you are calculating present value of deferred consideration, you will do 5 lakh into 0.75. If 5 lakh into the annuity factor means the sum of present value factor of all 3 years. What do you think? Which one is correct? Right now, Janani, our today chapter is what? Consolidation and business combination. Financial instrument we'll do tomorrow. So tomorrow you come again and you ask this question, okay? So today our target is only business combination and consolidation. Whatever you have doubt in these two chapters, we'll take that. But after completion of the top 95 question, means whatever the question included in my top 95 question list, that only I will do first. Okay. So who will answer me fast? Which one is correct? Everyone, you are not supposed to look into the answer. Just give me a fine answer. First option is correct. The second option is correct. Everyone. So of course, the first one is correct, second one is not correct. Second one is totally wrong, and normally students do mistake here because they have given all three present value factor, and sometimes students do this mistake. So of course the present value will be 5 lakh into 0.75. Can we proceed? Yes, sir. The shares and deferred consideration have not been recorded by A Limited. Like these shares, this has not been recorded and this has not been recorded. Means can you say only the cash consideration of 10 lakh has been recorded? Only the cash consideration of 10 lakh has been recorded. You can see in the balance sheet, if they have given investment in S Limited at cost and they have recorded only 10 lakh. 10 lakh means it is 1000 in 1000 means 10 lakh only. Means the share capital means the fair value of equity shares issued and the deferred consideration has not been recorded. So this is an error which we need to rectify while preparing the consolidation. Yes, sir. Below are the balance sheet of A Limited and S Limited as under. So they have given A Limited and S Limited balance sheet that you can read. Further information on the date of acquisition, the fair value of S Limited plant exceeded its book value by 2 lakh. Means they have given the fair value of S Limited plant exceeded its book value. Means they have given fair value gain. So they have given fair value gain on the date of acquisition. Thank you very much. And the plant had a remaining useful life of 5 years at this date. At this date. So they have what? Remaining useful life of 5 years. Okay, sir. You can see the date of acquisition is what? 1st April 2017 and the date of consolidation is what? 31st March 2019. Means it is 2 year post acquisition period. It means you need to charge additional depreciation on PP for how many years? 2 years. Got this point? Yes, sir. The consolidated goodwill has been impaired by 2,58,000. Of course, it will be the impairment loss for goodwill is given. That is also fine. The A Limited Group value NCA using fair value method At the date of acquisition, the fair value of 20% NCI is 3,80,000, and the fair value of NCI is also given in the question. Means all the information are given in the question. You are required to calculate CBS, and we are supposed to prepare CBS. Super easy question. I think nothing much. Only we need to think about this error, which whatever has been done in the given in the question. So how to solve? First, can you see we need to calculate PC, because the correct PC is not given, correct cost price of investment is not given. The cost price of investment is nothing but purchase consideration. So calculation of PC as per Ind AS 103. We calculate PC as per Ind AS 103, because on the date of acquisition Ind AS 103 will be applicable. Yes, sir. So cash payment how much given? 1,000 in 1,000. We are calculating in 1,000. Then fair value of equity shares issued. So how many equity shares issued? 2 lakh. And the market price is given 1.8. So it becomes 316,000. Yes, sir. And the fair value deferred consideration, it is what? The amount is what? A further sum of 5 lakh. It is 5 lakh. So it is 5 lakh. Actually, this is 5 lakh. So 5 lakh into 0.75 is equal to 375. It is 375. Okay. So this becomes the total purchase consideration. But out of 1735, can you say 1000 recorded? Means we need to again record 735. So for that we should think about the correct journal entry. So when we think about correct journal entry in the separate financial statement of parent company, what journal entry will do? Investment will increase by 735. Can you see equity share capital will increase by nominal value? Nominal value is 2 lakh into 1. 1 is the face value. And the balancing figure will be securities premium. So securities premium will increase by 1 lakh into 1 lakh into 0.8, 1 lakh into 0.8. Okay, sir. And the deferred liability will be increased by what? 375. So this become one journal entry on the date of acquisition. The rectification journal entry. Okay, sir. Now can you deferred liability, because deferred liability will be increased by the interest amount at the end of each year. So because right now we are, the post acquisition period is 2 years, and we are right now as on 31st March 2019. So we need to pass to interest expense journal entry. Correct. So we'll also think about interest expense to deferred liability. First year will be 375 into 10%. Then again on 31st March 2019, interest expense to deferred liability on the amortized cost that we can find out. So this becomes the total interest expense, and that interest expense will be debited to retained earning of parent company. So this interest expense of 37.5 plus 41.25 should be also debited to retained earning, and deferred liability will be increased by these two interest expense. So what will be the carrying amount of deferred liability as on the date of consolidation? That will be 453.75. That is equal to nothing but 375 plus 37.5 plus 41.25. If you have understood this much, it means the solution after this will be very easy. Have you understood this part? Have you understood this part? Everyone? Correct. Now my question to you all, you have done rectification journal entry in the books of subsidiary company. What rectification journal entry you will do in the separate financial statement of parent company? You have done the rectification journal entry. What rectification journal entry will be required in the books of subsidiary company? So the answer is no rectification journal entry will be done in the books of subsidiary company. Why? Because the shares have been acquired from the shareholders of subsidiary company, not directly from subsidiary company. So no rectification journal entry will be in the books of subsidiary company. Okay, so subsidiary balance sheet will not be affected by this particular transaction. Okay, sir. Yes, sir. Correct. Now can you say we'll do the consolidation process? We'll start consolidation process. Correct. Can you say first working note? Normally we do fair value adjustment, but because fair value gain is directly given, so that working note is not required. So directly we can start with the retained and with the AOP analysis of profit. So let us start with the working note AOP, and the closing balance is given how much? You can see the closing balance is given how much from the balance sheet of subsidiary given 300, and opening balance how much given? It is given in the first para, that is 125. So closing balance minus opening balance will be the profit, and no other adjustment is given. So this entirely, because the date of acquisition was the beginning of the year, so entire profit relate to the post acquisition period. So this become the post acquisition profit of how many year? 2 year, and this become the pre acquisition profit. Now we'll prepare statement of net asset. Statement of net asset. So statement of net asset will write on date of acquisition, post, and date of consolidation, date of acquisition, post and date of consolidation. The equity share capital has been given. How much it is given? If you see subsidiary company balance sheet, how much equity share capital given? You can see 500, and in this we'll add other equity, the pre-acquisition profit 125 and post-acquisition profit 175 as per previous working note, and this become total. And on this we'll do the fair value adjustment. The fair value adjustment, what is the fair value gain? 200, and we do charge additional depreciation of 2 years in the post-acquisition period. So that remaining useful life they have given 5 years. So 200 divided 5 into 2, that is how much? 80 will be reduced from the post-acquisition profit. Got this point? So it means our post-acquisition profit, which will be attributable to parent company NCI in the ratio of 80% 20%, will be 95, and that will be allocated to parent company and NCI. Got this point? And this become fair value of INA on the date of acquisition. Chalega? Yes, sir. Now coming to calculation of goodwill, again or bargain purchase. Now we'll take correct PC. So correct PC already we have worked out, that is 1735. Now we'll take fair value NCI, that is also given the question, that is 380, it is also given the question. This becomes the total is 2115 minus fair value of INA, that is 825. Already we calculated fair value of INA as per previous working note on the date of acquisition. On the date of acquisition, how much goodwill is coming? 1290. Of course it is full goodwill. Why it is full goodwill? Because we have used fair value method for NCI. We have used fair value method for NCI. Got this fine? So full goodwill. And for that impairment loss is given 258. So after impairment loss, what is the carrying amount of goodwill on the date of consolidation is 1032. Now again this impairment loss, because this impairment loss relate to full goodwill, this impairment loss will be attributable to both owner of parent company and NCI, and therefore it should be adjusted with retained earning and NCI in the next working note. Got this point? Yes, sir. Now next working note will be other equity and NCI. However, you can do other equity separate working note and NCI separate working note as per ICAI solution. Okay, sir. So we'll take this opening balance from what? From working note? No, from the parent company's balance sheet. So this we have taken from what? Parent company balances. Securities premium, because there was one rectification, because of that reason I have written securities premium. So there is no opening balance of securities premium. Okay, sir? Yes, sir. And NCI, this figure will take from previous working note, and you can see previous working note it was how much? 380, and we have taken this figure. Okay, sir? Yes, sir. Now can you say we'll do minus interest expense. What was that interest expense on deferred liability, which was an error? So that will reduce retained earning to interest expense, which is not yet recorded, will be how much? 2-year interest expense was 78.75, that will reduce. Then we'll also adjust securities premium not recorded. So securities premium not recorded is 160, that is added to the securities premium. Got this point? Yes, sir. Then we'll do plus minus, we share a profit of subsidiary company as per statement of net asset, that is given how much? We calculated 95, and 95 will be allocated in 80% and 20%. 80% and 20%. The impairment loss will be also allocated in 80% and 20%. You can see impairment loss 80% and 20%, it has been allocated, and this will be the final other equity and NCI. Final means the balance of this particular account in the consolidated balance sheet. Okay, sir. Now we can prepare what? The consolidated balance sheet. CBS will be very easy. I think in CBS, no doubt. CBS you can do. Without. Have you understood this point? So this one question may be expected. May be expected. Batao. Any doubt in this? Is the speed is okay? Or you want thoda sa slow? Is the speed is okay? Can you inform me? Is the speed is okay? Ki I will increase the speed or decrease the speed? Everyone. Because many students were requesting me that sir you should do it in a very fast mode. So I have increased my speed. Whether speed is okay, I should decrease the speed. Okay, chale, done. Okay, chalo, next question. Coming to next question. Next question is 25. What is question 25? Let's see. So coming to question number 25. 25. Acha, this is a very good question. This question is a very big question. I don't know whether this question will be asked or not, but a similar question can be asked in exam, because this type of question till now not it is not given the question. So expected is, this is 100% expected. Okay, Iswa Limited hold Investment Vinayak Limited. The draft balance sheet, two entities given. Iswar Vinayak. Okay, sir. You can see the draft balance sheet. Okay. Additional information. Iswar Limited investment in Vinayak Limited. On 1st April 2001, Iswar Limited acquired 400 million shares in Vinayak Limited by means of share exchange of one share in Iswar for every two shares acquired, to one for every two. So this is swap ratio given in Vinayak Limited. On 1st April, the market value of shares of Iswar Limited is rupees 7. Okay, sir. So this has been given to find out PC only. Iswa Limited appointed a professional firm for conducting due diligence for acquisition of Vinayak Limited, the cost of which is amounted to rupees 15 million. So this is the direct cost of acquisition as per Ind AS 103 should be charged to profit and loss account as an expense. Iswa Limited included these acquisition costs in the carrying amount of investment Vinayak Limited in the draft balance sheet of Iswa Limited. You can see what they have given in the investment account. This has been added. So it is actually, it is what, 15 million. So 15 million, if you want to convert 15 millions in thousand, you have to add 30. So if you want to convert 15 millions in thousand, you need to add 30. It means in this 15,000 has been added, which should be actually charged to profit and loss account. So this is one error. So from this we'll do minus 15,000, minus 15,000. Okay. And this will be charged to retained earning, debited to retained earning. Okay, sir. Yes, sir. Now, whenever in the question they give investment, only investment, check in this they have not given investment in S Limited. Means this includes some other investment, and because of that reason they have given PC information, which you need to calculate PC separately and just check what is the amount of PC. So any extra amount will be considered other investment, which will remain in the consolidated balance sheet. Which will remain in the consolidated balance sheet. Okay, sir. Yes, sir. Yes, sir. Coming to next point. There has been no change to the carrying amount of investment in Iswa Limited on balance sheet since 1st April 2001. Okay. Means there is no changes in the carrying amount of investment. Okay, sir. On 1st April 2001, the individual financial statement of Vinayak Limited showed the following balance. So they have given retained earning. They have given other component equity, means opening balance has been given. The directors of Iswa Limited carried out fair value exercise to measure identifiable assets and liability of Vinayak Limited at 1st April 2001. So this information has been given for the fair value adjustment. Property having a carrying amount of 800 million, land component 350, building component 450, had an estimated fair value of 1000 million, land 400, building 600. So it means fair value gain or loss we can calculate. The building component of the property has an estimated useful life of 30 years as on 1st April 2001. Okay, sir. Plant and equipment having a carrying amount of 600 million had an estimated fair value of 700 million. The estimated remaining useful life is how much given? 4 years. So this is also for fair value gain or loss. On 1st April 2001, the notes to financial statement of Vinayak Limited disclosed contingent liability. Now what Ind AS 103 says that any contingent liability of acquiring company can be recognized in the books of acquired company on the date of acquisition if two conditions are satisfied. First, there must be present obligation arising from past event, and fair value can be measured reliably. So whenever fair value of such contingent liability is given, it means it will become provision in the balance sheet of acquirer company. Got this point? So you can see on 1st April, fair value of contingent liability is given 30 million, means this contingent liability will be recognized as a provision in the books of Iswa Limited. The contingency was resolved in the year ended 31st March 2002, and no payment were required to be made by Vinayak Limited in respect of this contingent liability. Means it will be reversed. You can see the date of acquisition is 1st April 2001, and the date of balance sheet they have given what? 31st March 2004. Means how many year? 2, 3. Means it is how many year? So it means it become 31st March 2002, 31st March 2003 and 31st March 2004. It means 3 years. So 3 years is the post acquisition period. 3 years is the post acquisition period. Understood? Yes, sir. Correct. The fair value adjustment have not been reflected in the individual financial statement of Vinayak Limited. In the consolidated financial statement, the fair value adjustment will be regarded as a temporary difference for the purpose of computing deferred tax. Whenever they give this point, it means the carrying amount of INA of acquiring company is equal to tax base of INA. So can you say whenever tax base is equal to carrying amount, then whatever the difference between fair value and carrying amount, that will be fair value gain or loss. So fair value gain or loss will be considered temporary difference. On that we need to calculate deferred tax asset or liability. So for that purpose they have given 20% tax rate. Okay. The directors of Goodwill Limited use the proportion of net asset method when measuring the NCI. So Pasina method will be used. Okay, sir. Pasina means proportionate share in INA method. Impairment review of goodwill. In this particular question, they have not given impairment loss of goodwill. It means we need to first calculate impairment loss of goodwill on the date of consolidation by applying the requirement of Ind AS 36. So no impairment goodwill on acquisition of Vinayak Limited was evident when the review was carried out in the first year and second year. However, on 31st March 2004, means the third year, the directors of Goodwill Limited carried out a further review and concluded a recoverable amount of the net asset of Vinayak Limited is 2000 million. Vinayak Limited is regarded as a single issue for the purpose of measurement of goodwill impairment. Of course, we can do it. Then this para, one last para has been given. I'll read this para at the end. This is nothing but one more error in the books of parent company which will be rectified at the end. So I will read this para at the end. Previous CBS of Goodwill Limited at 31st March 2004. So super easy. Batao. What we are supposed to do? So can you say first we'll calculate what? PC. First we should calculate PC. PC will be how much? Batao. What will be PC? It is 400 equity shares acquired. Swap ratio is 1/2. Correct? And into what? 400 shares acquired. Swap ratio is 1/2 into 7. How much? 400 divided by 2 into 7. So it is what? PC is equal to what? Correct? Means we have calculated in 100. This become 1400. Means it become 14 lakh. 14 lakh. Means you can see out of this 21 lakh 15,000 minus 15,000 is what? That cost price of investment. That is direct cost of acquisition included in the cost price of investment, and 14 lakh will be the amount of PC. So minus 14 lakh will do, and that whatever left, that become what? That become the other investment that will remain in the balance sheet. This point I hope you have understood. So PC is equal to what? 14 lakh. PC is equal to 14 lakh. Now let us do the first working note. That is what? Let us do the first working note. That is fair value adjustment. Can we start? Follow. So I have the solution for you all. This is the solution. You can see. So holding ratio, so you have understood, it is holding ratio is what? 4 lakh shares acquired out of 5 lakh. So 80% is the holding ratio. So you can see the total shares acquired 400 million, means it is what? 4 lakhs. And how many shares capital given is 5 lakh. Face value is 1. So it is 5 lakh to 80% acquired. So NCI become 20%. This you can easily calculate. Okay. Date of acquisition and date of consolidation also you have understood. Now coming to the first working note, fair value adjustment. So we have land, building, plant and equipment and provision. Means this is very interesting provision. For the first time they have given in any question of consolidation. Okay. So can you say fair value is given? That is given. Carrying amount is also given in the question. So any increase in the asset will be gain. So it is gain, gain, gain. But any increase in the liability will be loss. So this will be loss. So you can see liability has been increased by the amount of fair value only because the carrying amount was 0. Because the carrying amount was 0. Understood? Yes, sir. Now we'll find out additional depreciation. So for this, the remaining useful life is 30. So we'll do 3/30. For this, remaining useful life is 4. So we'll do 3/4. So this will be additional depreciation. And whatever balance left, that is net changes on the date of consolidation. Okay, sir. But provision amount, what they have said, the amount of provision is no longer required because the payment was not supposed to be done. So that will reverse. So you can see 30,000 negative. If you want to reverse it, you will make it positive. So when you reverse any provision, can you say that will increase post acquisition profit? So reversal of provision will increase the post acquisition profit, and therefore we have added, and the ultimate effect will be 0 in the consolidated balance sheet. Okay, sir. Any doubt? Correct. Now we'll do working note. Next working note, AOP analysis of profit. So they have given retained earning and other component equity. Closing balance is given the balance sheet of subsidiary company. Correct. And opening balance is given as an additional information. And believe me, there is no adjustment. There is no adjustment. Normally we think about how many adjustment. Normally we think about 4 adjustment. Any dividend paid, so no adjustment for dividend paid by subsidiary company. Correct. Any bonus shares declared by subsidiary company, no bonus shares has been declared by subsidiary company. Correct. Okay. So any abnormal loss in the books of subsidiary company, there is no abnormal loss. Any error in the books of subsidiary company, there is no error in the books of subsidiary company. So normally this type of adjustments are given, but in this question there is no adjustment. So normally whenever you are doing AOP, think about dividend paid, no. Bonus share, no. Any error, no. Any abnormal loss, no. Just think like that. So it means there is no adjustment. So this will be allocated to pre and post acquisition profit. Once again, the date of acquisition is the beginning of the year. This will be entirely post acquisition profit, and the opening balance will be pre acquisition profit. So you can see the pre acquisition profit is what? 7,50,000 plus 25, that is 7,75,000, and post acquisition profit is this plus this. Okay, sir. Yes, sir. Now we can prepare SONA. So SONA में we write down date of acquisition, date of consolidation, post and post retained earning and other equity will come. Yes, sir. So we write down equity share capital, equity share capital. Then we write down other equity as per previous working note, and you can see this is the post acquisition profit in retained earning other equity. This become the balance. Now in this balance we'll do fair value adjustment. We'll do fair value adjustment as per the working note. The fair value adjustment of land, building, plant and equipment provision. This become fair value gain and loss. If gain, add loss minus, you can see gain has been added, loss has been deducted, and then post acquisition adjustment will be done. So land, there was no additional depreciation, building additional depreciation, plant and equipment additional depreciation, and provision got reversed, which will increase post acquisition profit and the net effect in the consolidated balance sheet. Correct. So this become what? 15,45,000. This is the fair value by INA on the date of acquisition. This is the post acquisition profit. Correct. And this is the carrying amount of INA on the date of consolidation. Got this one. But this is before deferred tax. Now we should think about deferred tax also. So already they have given the question that fair value adjustment is regarded as a temporal difference. But if that is not given, can you say this is the fair value? Means initial carrying amount in CFS, and this is what carrying amount in IFS. So whenever tax base is not given, what we assume tax base is equal to carrying amount. Correct. So in this case, the taxable or deductible temporal difference will be this minus this only, which is nothing but equal to the total of this. And therefore, if there is a fair value gain, means total is, this total is what? This total is fair value gain. So gain will be taxable in future, therefore it will be taxable temporal difference. But if it is a fair value loss, loss will be deductible in future, and therefore it will become deductible temporal difference. Because it is a gain, so it means it become taxable. Taxable means DTL. So we will find out DTL on this. So what is the total of this? So total of this you will see it will be 2,70,000. 2,70,000 into 30%. We'll calculate DTL, and you can see we have recognized DTL of 54,000. DTL of 54,000 on the date of acquisition. But can you say due to post acquisition adjustment it will reverse, and you can see there is some reversal of taxable temporary difference. So this is the reversal of taxable temporary difference. This amounted to rupees 60,000. So 60,000 into 30%, how much? 60,000 into 30%, how much? Batao. It is, sorry, my mistake. It is 20%. I have written wrong. I think it is 20%. Tax rate is what? 20%. Okay. So this is 20%. 20%, 20%. So 60%, 60,000 into 20%, it is 12,000. So can I say when we reverse DTL, the reversal of DTL will be will be income or expense. So of course this will be DT income. So DT income will be added to the post acquisition profit, and the net DTL in the CBS will be 54,000 minus 12,000, that is 42,000. That will be net DTL in the balance sheet. Okay, sir. And this will be the final. So this become fair value of INA on the date of acquisition. This become post acquisition profit after what? Deferred tax adjustment. After deferred tax adjustment. This was super point in this question, which is not yet asked in exam. Can be asked in exam because deferred tax adjustment till now not asked in consolidation question in exam. Have you understood this point? Any doubt? Of course, can I say this post-acquisition profit will be attributable to parent company and NCI in the 80% and 20% whatever we have calculated at the beginning. Whatever we have calculated at the beginning. Any doubt in this? Batao. Have you understood this particular adjustment? Can you respond fast? Okay. Yes, sir. Now let us calculate goodwill or gain on bargain purchase. The formula is very simple. Fair value of consideration paid. Already we calculated 14 lakh. Then value of NCI by using Pasina method, that will be 20% of fair value by INA, that is already calculated. I always say that you do in this way because if we calculate INA separately and DTL separately, sometimes what we do, we forget to adjust DTL with the INA. So I will say INA and DTL do in the same working note so that you can find out the fair value by INA after DTL adjustment. So always NCI will be 20% of fair value of INA after DTA adjustment, after DT adjustment. So if it is DTA, will plus DTA. If DTL, will do minus DTL. Okay, sir. Yes, sir. So 20% of 14,91,000. So this become value of NCI as per proportionate share in INA method. From this minus fair value of INA, this will become the amount of goodwill. Amount of goodwill. But in this question, we need to also find out impairment loss of goodwill. So how to find out this, that we need to understand. For that, we need to do one more working note. We do one more working note. The next working note is impairment loss as on 31st March 2004 as per the requirement of India 36. So because subsidiary company has been treated as single CGU, so can you say there are goodwill, another asset will make in two columns, goodwill, other asset and total. Goodwill, INA and total. So what is the carrying amount of goodwill? That is already we calculated 2,07,200. This amount will come, and INA will be this amount. But this INA will take which INA? But this INA will be which INA? INA on the date of acquisition, the INA on the date of consolidation from your point of view. So this should be INA on the date of acquisition, the INA on the date of consolidation. So of course, can you say because we are doing impairment testing on the date of consolidation, and therefore this should be INA on the date of consolidation, and therefore we have taken this figure 17,68,000. This figure we have taken because impairment review has been done on the date of consolidation. So we will take INA on the date of consolidation. This is also super point. So this plus this will be equal to this, but can you say because it is partial goodwill? Why it is partial goodwill? Because we have used Pasina method for NCI. So it will become partial goodwill. So what our India 36 says that for the impairment purpose, will make partial goodwill, will convert partial goodwill into what? Full goodwill. Therefore, can you say will add unrecognized share of NCI in goodwill, that is 20%. So what will do? 2,07,200 into 20 by 80, and this amount will come, and this will become full goodwill, and this is the full INA, and this become full carrying amount. Understood? Now we'll compare this with the recoverable amount, and recoverable amount is given 2,000 million. 2,000 million is nothing but 20 lakh. Is nothing but 20 lakh. So you can see this recoverable amount is less than what? Carrying amount, and therefore there is an impairment loss. Total impairment loss of 27,000, and this will be entirely allocated goodwill. So you can see this has been entirely allocated goodwill. But out of this goodwill, can you say because this impairment loss 27,000 is belonging to both parent company and NCI, but NCI we cannot, NCI means impairment loss of goodwill to the extent of NCI share cannot be recognized, and therefore will do minus NCI share, that is 20% of 27,000 will not recognize as an impairment loss. Why? Because it is partial goodwill. partial goodwill. Okay, sir. So 5,400 will do minus, and the balance, this is the impairment loss to be recognized. Impairment loss to be recognized. So what is the amount of impairment loss on goodwill? That is 21,600, and you can see we have deducted 21,600, and this will be the final carrying amount of goodwill in the consolidated balance sheet. In the consolidated balance sheet. Okay, sir. Understood this fine? Bolo. Have you understood this fine? Have you understood this point? Yes, sir. So once you have understood this point, now we can do the other equity and NCI. So other equity, these two balance will take from the parent company balance sheet. So of course we have taken from there, and this NCI we have taken from previous working note, means working note of the goodwill or gain on bargain purchase. Of course we can take this, means this is the initial value of NCI. Now let us do the adjustment. First adjustment was what? Direct cost of acquisition, which has been added to the cost price of investment. Now it will be charged to retained earning. So you can see 15,000 direct cost of acquisition I have deducted from retained earning. Okay. Second adjustment, sharing profit. So you can see sharing profit. So this will be allocated. This will be allocated to parent company, and this will be allocated to NCI. So we have already allocated this. You can see we have transferred, and we have added this to retained earning, this to other equity, and this to NCI. Then impairment loss, because impairment loss is on partial goodwill, therefore impairment loss will be entirely attributable to parent company, and therefore debited to what? Retained earning. Got this point? This much I think, no doubt. This much I think, no doubt. After this I will explain. Any doubt up to this? Now the last para. Let me explain you the last para. The last para is what? Last para. Can we read the right last para? Yes, sir. On 1st April 2003, ISWA Limited completed a construction of non-current asset with an estimated useful life of 20 years. The cost of construction were recognized in PP and depreciated appropriately. Means PP there is no mistake. The construction cost was recognized properly and depreciated properly. So there was no error. ISWA Limited has a legal obligation to restore the site on which non-current asset is located on 31st March 2043. The estimated cost of this restoration work at 31st March 2043, means after 20 years, is 125 million. So this is future expenditure. The directors of ISWA Limited have made a provision of 6.25, that is 125 divided by 20 in the draft balance sheet. But whether it is correct, this is 100% wrong, because provisions will be recognized at present value of 125. The present value will be what? They have given the annuity present value factor 31.2 paise, which is 0.312 in rupees. It will be 125,000 in 1000, 0.312. This will be how much? 1,25,000 into 0.312. That is 39,000. Means actually the provision of 39,000 was required, but they have made a provision of 6.25. This was the first mistake. Second, what they are saying, directors of ISWA Limited have made a provision of 6.25, but nothing has been given for capitalization. So can you see, nothing has been given for the capitalization, means it has been charged to PL. Because normally what we say, the provision has been created. The provision has been created from PL account. It means it has not been capitalized. The second mistake is that this 39,000 has not been capitalized with the cost price of PP. So what rectification journal entry you will do? Batao. If you want to support me, batao what rectification. The first journal entry will be what? We'll say PP account debit. It should be increased by 39,000. and provision should be increased by 39,000. But can I say out of this 39,000 already how much provision has been created? 6.25, means it is 6250. If you see the balance sheet, in the balance sheet provision is already coming 6250. Check karo. It means this is already recognized. You will increase your provision by 6250, but this 6250 has been transferred to PL. Therefore, can I say we need to do some rectification PL. PL means retained earning. So your retained earning will increase by what? 6250. So your retained earning will increase by 6250. This is the first rectification. Second, can I say in the amount of provision, because now 1 year has been expired, because this provision we create at the beginning of the last year. So 1 year has expired, so we need to also add interest cost. So what we'll do? Interest expense, which will be also debited to retained earning, to what? Provision, to provision, and that will be increased. The interest expense will be 39,000 into the rate of discount. Rate of discount is how much? It is already given the question. The rate of discount was how much? It is 6%. So into 6% will do into 6%. So 39,000 into 6%, that is 2340. 2340, correct. And can I say on this amount of PP which was which is the uh, amount of provision which has been capitalized, we should also charge depreciation on this amount for 1 year. So one more rectification journal entry will be depreciation, which will be also debited to retained earning account debit to what? PP. How much? 39,000 divided by 20. 20 is the useful life. So 39,000 divided by 20 is equal to 1950. 1950. Understood? Means what you will do? First you will add how much to retained earning? 6250. Then how much minus from retained earning? 2340. Then how much minus from retained earning? 1950. Or you can do the net effect also, that is your choice. And you will increase your PP by 39,000 minus 1950, and you will increase your provision by what amount? That is 39,000 minus 6250 plus what? Plus 2340. This much provision will increase. The provision will increase by 35090, because already 6250 has been already recognized in the balance sheet. So you will only add how much? This amount plus what? This amount in the balance sheet of the provision. If you do this much, your balance sheet will tally. Okay, sir. I hope the entire working note you have understood. Any doubt in the last para? This last para is a very important para given in this question, which can be asked in any other question also. But have you understood this last para? After that, can I say you can find out this other equity and share the final balance, and then you can prepare CBS. CBS, of course, you can do. CBS, I don't think that you require my help. Okay, sir. Any point? Any point which you have not understood for this particular question? I'll wait. I'll wait for 1 or 2 minutes. Follow. Any doubt? Can we take the next question? Let us come to the next question, 27. This is also one very good question asked in exam, but I like this question personally because this is related to what step acquisition. Okay, sir. The extract of balance sheet of Hamel Limited and its subsidiary Slick Limited as on 31st March 2023 are given below. Hamel Limited, Slick Limited. Okay. You can see PP, they have given entire balance sheet has been given. You can read once. Okay, sir. Yes, sir. Chalega. Have you read it? Yes, sir. Then if you see the notes to account, PP has plant and machinery, furniture and fitting. Intangible asset as Goodwill. And you can see Goodwill is coming in the balance sheet of subsidiary company. This is one special point I need to give a stress on this. Then other equity, we have general reserve, return earning, borrowing, 8% debenture of rupees 100 is 1 lakh. Okay. And if you see the investment, means that will be given in the next para. Okay, sir. Now, additional information what they are given. Hamel Limited acquired 20,000 equity shares Slick Limited on 1st April 2002 at a cost of rupees 2,40,000 and further acquired 17,500 equity shares on 1st October 2022 at a cost of rupees 1,92,500. So, of course, it is a question of step acquisition and this will become the date of acquisition. Date of acquisition. Okay, yes, sir. The 8% debentures Slick Limited include debenture held by Hamel Limited of nominal value of 35,000. These were acquired by Hamel Limited on 1st Jan 2022 at a cost of rupees 84,000. Means if you see this investment account, consists of what? It consists of 2,40,000 plus 1,92,500. So this is 2,40,000 plus 1,92,500 plus they also purchased the debenture of subsidiary company at rupees 84,000. At rupees 84,000. Just check whether the sum total is coming 6,25,000 or not. So 2,40,000 plus 1,92,500 plus 84,000. So it means there is some other investment also. So what will be the other investment? That is plus 1,08,500. 1,08,500. Got this fine? Have you understood? Chalega? Any doubt? Okay, sir. So this is what? First they have acquired how much? First they have acquired 20,000 equity share, then they acquired 75,500 equity share, then they acquired debenture. So I have just given the bifurcation of investment given in the balance sheet. Now, if you see this para, what they have given, this is one special point. If they have acquired out of 1 lakh, they have acquired 35,000 nominal value at a cost of rupees 84,000. Correct. So this is nothing but one type of intercompany balance which will be cancelled in consolidated balance sheet. And because we have paid some extra amount, that will become loss and that loss will be debited return earning. So how much extra amount they have paid? You can see 84,000 minus 35,000. The extra amount is 49,000. So this 49,000 will be debited to return earning. This is one special point. Chalega. Can we proceed? Yes, sir. Then they give return earning of Slick Limited at a credit balance of 75,000 on 1st April 2002 on the date balance sheet, on the date of balance, the balance of general reserve is 50,000. So they have given opening balance of return earning and general reserve. Slick Limited had paid a dividend at a rate of 10% on its paid up equity share capital out of the balance of return earning as on 1st April 2022 for the financial year 21-22. One thing is clear, this is final dividend. And you can see the date of payment is not given. So of course, whenever date of payment is not given, we need to assume something. So what assumption required that I need to explain. The entire dividend received by Hamel Limited was credited in SOPL. So for this, no adjustment required. As per the resolution dated 28 Feb 2003, SEEC Limited had allotted bonus shares at a rate of 1 equity shares for every 10 shares held out of general reserve. The accounting effect has not been given. So when I have done bonus share adjustment, I say they come in two situations. If the journal entry of bonus share has not been done, so I have said there is one shortcut that ignore the entire effect of bonus share from consolidation solution. Means because the journal entry has not been done, so just I will say delete it. There is no need to think about this. More you think, more mistake you will do. So whenever bonus share given, the bonus share declared by subsidiary company, but no journal entry has been done, ignore that from consolidation purpose and then write down one note, because the bonus share will not affect the net asset of the subsidiary company before and after bonus share, and therefore it has been ignored from the above solution. Only this note you write down. Because if you do some adjustment, there is a high chances you will do mistake. If the journal entry has been done, so of course, then you should think about that particular adjustment. So I'll just take one example to explain you. If the bonus share adjustment has been done, your journal entry has been done, then what you should think, then what you should do in this particular question, in this type of questions. Okay, sir. This point have you understood? Yes, sir. Trade receivable of Hamel Limited include BR of 2 lakh drawn upon SEEC Limited. Of this, 50,000 has been discounted with the bank. So can you say how much undiscounted? Undiscounted is 1,50,000. You will cancel 1,50,000. So any bill which is not yet discounted will be cancelled. Any bill which is already discounted cannot be cancelled because that will become the actual liability in the balance sheet. Okay, sir? Yes, sir. During the financial year 20 to 23, Hamel Limited purchased goods from SEEC Limited. Goods from SEEC Limited. So it means SEEC Limited has sold to Hamel Limited. It become upstream. 25,000 at a sale price of 30,000. What is the total profit? 5,000. Total profit 5,000. 40% of these goods remain unsold. So we'll do into 40%. Into 40% means what? 5,000 into 40%. So this is 2,000 URP. Because it is the profit of subsidiary company included in the stock of parent company. Means, are you getting what I am saying? Yes. So it become upstream. So whenever upstream, either you do this adjustment in AOP or directly you can do in the working note of other equity NCI. That is your choice. So I will say do in AOP. So from when you are doing AOP, once you have calculated post acquisition profit, from that you deduct this profit. Okay, sir? Yes, sir. On 1st October 2002, machinery of SEEC Limited was overvalued by 20,000. It was overvalued. Overvalued means now you need to reduce it by 20,000. So they have given fair value loss. You need to understand the English also. This is not fair value again. They have given fair value loss, for which necessary adjustment are to be made. Depreciation charge at a rate of 10% per annum. So whenever they have given fair value loss, directly 10% will be applied on this to find out saving in depreciation. You will find out saving in depreciation. So of course the post acquisition period will start from 1st October. So 1st October means 6 months. So your saving in depreciation will be for how many months? 6 months. Okay, sir. The parent company, that is Hamel Limited, has adopted an accounting policy to measure NCI at fair value. To fair value method. Okay, sir. Assume the fair value per equity shares is 11 on the date when the control was obtained. So fair value of equity shares of subsidiary company, they have given 11 to find out fair value of NCI. Very good question. Very good question. Any doubt? In the question only, is there any doubt? I think no doubt. I have explained each and every point. Now let us come to the solution. Now you can see what is the question. When I am saying at this point of time 20,000 equity shares were acquired, we need to find out what is the percentage of shares acquired. So 20,000 divided by total number of shares of subsidiary company, that you will find out from the balance sheet. So it means it is 40%. Correct. And on this date 17,500 acquired out of 50,000. So that become 35%. But be careful one point. Whenever they have given bonus shares, if the journal entry has not been done, then so very simple. But if journal entry has been done, then be careful. If the journal entry has been done, it means this 50,000 is after bonus shares. But can you say when you are calculating holding ratio, both numerator and denominator should be either before or after bonus shares. So can you see if 20,000 is before, so 50,000 should be also before bonus shares. So if journal entry has not been done, Can you say whatever share capital is coming in the balance sheet of subsidiary company, that is before bonus years only, and therefore this question become easy. If the journal entry has been done, then super difficult question. They become super difficult question. Got this point? Are you able to follow me? Yes, sir. So can you say now the total becomes 75%, and on this date control is obtained. On this date control is obtained. Only one point. Now they have given that final dividend was paid. Final dividend was paid, but the date of payment was not given. Normally, whenever I have done some question without step acquisition, I used to say if final dividend paid, but if the date of payment is not given, always assume it is paid after the date of acquisition. But for this particular solution, what ICAI has assumed that it has been paid after this acquisition, but before this acquisition. I don't know why they have assumed this, but we need to follow this as same assumption. If the step acquisition question they ask, whenever step acquisition question, so what I assume if the final dividend date of payment is not given, so I assume it has been paid between the two acquisition date. Between the two acquisition date. Okay, sir. So this means final dividend is paid before the date of acquisition. Before means during pre-acquisition period. During pre-acquisition period. Understood? Yes, sir. Chalega. Now we can do the solution. The holding ratio, so you have understood 40%, 35%, 75%, NCA become 25%. Correct? This is very much dangerous because bonus year journal entry has not been done. It becomes super easy. Okay, sir. Now date of acquisition is 1st October. Date of consolidation is 31st March. So time ratio is 6:6. Means pre-acquisition period is 6 months. Post-acquisition period is 6 months. Now we'll do fair value adjustment. So they have given in the question that fair value loss of machinery because it was overvalued by 20,000. Correct? So fair value loss has been given. Correct? Now we'll do less saving in depreciation for 6 months. So we'll do 20,000. Rate of depreciation into 6 by 12. That is how much? It is 1,000. So your net changes will be 19,000 on the date of consolidation. Super easy, without working note also you can do. This particular point you can do without working note. Okay, sir? Yes, sir. Then coming to AOP. AOP is interesting in this. So AOP, can you say we'll take first closing balance from the subsidiary company balance sheet. Then we'll take opening balance given in the additional information. This will be the difference you can find out. Correct? Now always think about 4 adjustment. Any final dividend paid? Yes, paid. So final dividend paid will be added. The final dividend they have given at what rate? 10%. 10% of capital before bonus shares. So in this case, bonus year journal entry has not been done. So it becomes very easy. But suppose bonus year journal entry has been done, then whatever capital is coming, that is after bonus year. So we should find out first capital before bonus years and then find out final dividend. Why? Because final dividend is related to previous year and bonus year has declared in current year, and therefore 10% will be on share capital before bonus year. So this is very easy. 10% of 5 lakh. So 50,000 will be added. Final dividend. Bonus year, second adjustment bonus year, but journal entry is not done, ignore it. So bonus year, journal entry not done, ignore it. Okay, sir. Then any error, there is no error. There is no error. Correct. Any abnormal loss, there is no abnormal loss. So normally, always think about these 4 adjustments. First, final dividend or any dividend, dividend paid or payable, dividend paid or payable. Samjhe? Dividend paid or payable. Second one, bonus year. Third one, abnormal loss. Fourth, error. Correct. Normally, out of these 4, 1 or 2 will be given. In this, only 1 has been given. You can see bonus here, so we have totally ignored. Bonus here, so we have totally ignored. It is dash dash. So this become profit, and this will be allocated in time ratio, that is 6:6. So you can see we have allocated to pre-acquisition and post-acquisition profit in 6:6 months. Then opening balance will be added to what? Opening balance will be added to what? Post-acquisition profit. Understood? Sorry, my mistake. Opening balance will be added to the pre-acquisition profit. Pre-acquisition profit. Understood? Any doubt? Correct. Now, final dividend, can is a final dividend. Now we'll deduct. So be careful. If the final dividend is paid during post-acquisition period, deduct from post-acquisition profit. But if the final dividend is paid during pre-acquisition period, deduct from pre-acquisition profit. Understood? This is very important. So in this question, what assumption we have taken that final dividend is paid during pre-acquisition period? pre-acquisition period, because that assumption has been taken by ICAI. So same assumption I am taking, and therefore we are deducting from pre-acquisition profit, and you can see we have reduced final dividend from pre-acquisition profit. This is a super point where you can do mistake. Have you understood this point? Why we have deducted from pre-acquisition profit? Why we have deducted from pre-acquisition profit? Have you understood? Bolo. Have you understood this point? Why we have deducted from pre-acquisition profit? Yes, sir. Today you are not responding, so I'm not getting that motivation to teach. You need to respond. If you are not responding, how can I teach you? Because only speaking, that will not work. If you'll do like this, next time I will not come. I am coming live only for you. No matter how many students are there. But if you have few students, you need to respond. Okay, sir. Respond. You need to respond. How can I understand that whether you are listening or not listening me? I'll wait for 2-3 minutes. I want response from everyone, whoever is listening. Otherwise, there is no need of only saying this. If I will say no need to take live class, I would have recorded and uploaded it now. You want me to record and upload it? I can do that also. नहीं कर रहा। चलो now are you with me everyone? बोलो। Everyone just respond, are you with me? Now you need to respond, otherwise I will means it will not be possible to teach you. Okay, if you are not responding, how can we I understand that you are listening me? Whenever I am asking a question, just respond, okay, whether you have understood or not, so that I also feel that yes, you are listening me. Okay sir? So what was my question? That if the final dividend paid, if the final dividend has been paid during pre-acquisition period, deduct from pre-acquisition profit, and it has been paid during post-acquisition period, deduct from post-acquisition profit. In this question, what assumption we have taken? It has been paid during pre-acquisition period, and therefore we are deducting from pre-acquisition profit. Okay, sir? We are deducting from pre-acquisition profit. Then bonus here, to already I have said ignore. Now, in this particular solution, I have not used the shortcut, I have used the conceptual way, but let us ignore it. So, if I ignore it, don't deduct. Okay, your final answer will remain same. Your final answer will remain same. So, bonus say you have totally ignored. So, in exam, I will say better point is that whenever bonus year journal entry has not been done by subsidiary company, ignore it entirely from the consolidation working note. Okay, sir? Yes, sir. Then there is one unrealized profit due to upstream transaction, and the profit was 2000. Already we calculated, that is deducted from post acquisition profit, and you can see that we have deducted from post acquisition profit. So it will change the final answer will change. So it will be 1,75,000 plus 50,000. So this will be 2,25,000 now. Okay, sir? Yes, sir. Chalega. Correct. You can see it has been assumed that final dividend is paid before the date of acquisition. Correct. As no journal entry has been made for bonus year, it can be totally ignored from consolidation adjustment. That also I have given as a note. Now, Sona, date of acquisition, date of consolidation, post. So equity share capital already. And can you say bonus year adjustment will be totally ignored? So we have totally ignored it. And now retained earning, this will be 2,25,000. So you can see the final answer remains same. Whether you have taken bonus year into consideration or whether you have ignored it, you can see 5 lakh plus 2,25,000 will be 7,25,000 only. And that is the post acquisition profit that you have added, and this is what the total you have written. So you can see this become the final answer before what fair value adjustment. This become before fair value adjustment. Now you do fair value adjustment, already working note we have done. There was a loss of 20,000 on the date of acquisition. Saving in depreciation 1,000, that will be added, and that will be 19,000. So this will be the net asset on the date of acquisition and on the date of consolidation. But one special point. You can see whenever we say net asset means what? Equity share capital plus other equity. That only means this SONA is nothing but to find out INA. But can you say when you are taking equity share capital plus reserve and surplus, we are taking total asset minus total liability. So when we are saying total asset, that will be including goodwill. It means, can you see this INA is excluded? This INA is actually including goodwill that is given in the balance sheet of subsidiary company. But we want INA excluding goodwill, and therefore we should reduce this INA by the amount of goodwill which is already appearing in the balance sheet, because we want INA INA means what? Excluding goodwill. INA means what? Excluding goodwill. So can you say, because this is including goodwill, we will do minus goodwill, whatever is given in the balance sheet, and then deducted, and that will become INA. Now this become INA excluding goodwill, because we want INA excluding goodwill, because goodwill will be only calculated as a balancing figure in the working note, next working note. Understood this point? Have you understood this point? This become one special point. Now this become post acquisition profit. This will be allocated to parent company NCI in 75% and 25% ratio. Any doubt in this? Have you understood the point of goodwill? Goodwill point, goodwill adjustment, have you understood? Okay, yes sir. Chalo. Now let us do the next working note, goodwill or gain or bargain purchase. So what we'll do, fair value of consideration paid already, that is given in the question. So that is given for 35%, 1,92,500. Correct. Then we'll do fair value of previously held equity interest. So previously held equity interest, how many shares they have acquired? 40%. 40% of 50,000 means how much? 20,000 equity share they have acquired. So fair value previously had equity interest. So 20,000 to 11, this will become 2,20,000. And can I say on this we'll also find out remeasurement gain and loss. Remeasurement gain and loss. Okay, that is the next working note. So whenever there is step acquisition, we need to remeasure the previously held equity interest at fair value, and any difference between fair value and carrying amount will be transferred to PL, will be transferred to PL or OCI as the case may be. If nothing is given, always it will be transferred to PL. Okay sir, yes sir. Then because in the question it is given fair value, means fair value method for NCI, so fair value of NCI for 25%, so 25% of 50,000 equity shares, that will be how many shares? 50,000 into 25%, that is 12,500, and 11 is the fair value of equity share. So into 11, this become the fair value of NCI. Fair value of NCI. So this become total from this minus fair value of INA, that is already calculated. How much we calculated? 6,30,000, and this will be the amount of gain on bargain purchase. Amount of gain on bargain purchase. Understood? And this will be transferred to capital reserve, and it will be shown in the balance sheet as capital reserve. Any doubt? No doubt. Then can you say one more working note? Remeasurement gain and loss on previously held equity interest. Correct. So fair value is 2,20,000. Carrying amount is given 2,40,000. As the cost price it is given 2,40,000. So you can see there is a loss on remeasurement, and that will be transferred to PL. From PL it will go to retained earning. It will affect the working note of retained earning. Okay sir. Now, just try to understand. As per ICAI solution, there is some difference with what ICAI has done. ICAI have taken this. ICAI have taken this. ICAI has taken this also. This up to this ICAI is same. But what they have done, when they are taking fair value of INA, they have taken fair value of INA including goodwill. From my point of view, it is super mistake. However, ultimately the solution remains same, but you need to understand concept. So they have taken 7,05,000, means they have taken this amount, which from my point of view is not correct. 7,05,000. So they are calculating gain or bargain purchase 1,55,000, and how much goodwill is given in the balance is 75,000. Sorry, goodwill given in the balance sheet is how much? Goodwill given in the balance sheet is how much? Check karo. It is given, goodwill given in the balance sheet is 75,000. So you can see goodwill given in the balance sheet is 75,000 and 1,55,000 gain. So ultimately net effect is what? 80,000 only. So ultimately the effect remains same. But you only say in the balance sheet, can you show goodwill and capital reserve separately? Means this much capital reserve, this much goodwill, that is totally bakwas. Means you need to either mention goodwill or you need to mention capital reserve. You can't write both. You can't write both. So that is the mistake ICAI has done. From my point of view, that is totally wrong. This is only correct. If you want to follow IC solution, you can follow, but that is not correct. I can prove it right now. What is wrong? Suppose in the question they have given pasina method. So you only say pasina method. So 25% of 6,30,000 you will take, or 7,05,000. It will be 6,30,000 only. Because pasina method means what? INA means what? Excluding goodwill, and therefore it should be 6,30,000. Because this question is payable method, and therefore answer match. But if suppose it is pasina method, so ICAI answer will be wrong, and my answer will be 100% correct. So I will say better do in my way, because conceptually it is 100% correct. Conceptually it is 100% correct. Okay, sir. Got this point? Have you understood? Yes, sir. Remeasurement gain and loss, so you have understood. Now let us come to last working note, other equity and NCI. So what will take? This balance will take from parent company balance sheet. This balance will take NCI from previous working note. Understood? Then share in profit as per the post acquisition profit allocation we have already done, that will be transferred. Yes. Then there is one remeasurement loss, that will be transferred to what? Retained earning. Then there is one debenture cancellation, initial point 84,000 minus 35,000, 49,000. So that loss will be also debit to retained earning, and this will be what? The final answer. Final answer. Balance sheet, of course, you can prepare. Balance sheet will, I will not take any time. Correct? Only one point. In investment, can you say now this will remain and this will remain. So this will be the investment in the CBS. And out of this 1,35,000 will be deducted, and balance will remain in the balance sheet. That is one point which I have said. Got this point? Balance you can do by your own. Chalega? Yes, sir. So this is also question we have concluded. Next point. What is the next question? 27 we have done. Come to question of 40. Now question 40 is a question of loss of control. Question 40, this question. Good question, till now not asked in exam. As at the beginning of his current financial year, AB Limited hold 90% equity interest in BC Limited. During the financial year, AB Limited sells 70% of equity interest in BC Limited, so 20% retained. Correct? For a total consideration of 56 crore, and consequently loses control of BC Limited. At the date of disposal, the fair value of 20% interest retained is 16 crore, and the net asset of BC Limited are fair valued at 60 crore. This is the net asset. Now this net asset include debt investment classified as FBTOCI of 12 crore. Means 60 crore is inclusive of 12 crore. So don't do any adjustment for 12 crore. But related FBOCI reserve is 6 crore. Can you say out of this 90% belong to parent company and 10% belong to NCI? So 10% is already added in NCI. For that no adjustment. But 90% will come in the balance sheet as FBOCI reserve. CBS as FBOCI reserve. So 90% is how much? 6 into 90%, that is 5.4. 5.4. Net defined benefit liability of 6 crore, and that resulted in reserve relating to net measurement loss of 3 crore. Out of this 90% is how much? That is 2.7. Equity investment considered not held for the purpose of trading of 10 crore, for which irrevocable option of recognizing the changes in fair value in FBOCI has been availed, and written FBOCI reserve 4 crore to 90% is 3.6. Net asset of foreign operation 20 crore and related FCTR is what? 8 crore. This is becomes 7.2 90%. So what our Ind AS 110 say that whenever there is a loss of control, then of course you need to de-recognize all the INA and goodwill of subsidiary from the CBS, along with any OCI component of subsidiary will be also what? Closed. How it will be closed? As per respective Ind AS. Means if the OCI can be of two types, either reclassified to PL or not reclassified to PL. If it is reclassified to PL, it will be transferred to PL. If it is not reclassified to PL, it will be closed by transfer to retained earning. Got this point? These are the 2 points. So what we need to understand for this means for the debt instrument, Ind AS 109 say that it will be reclassified to PL. So this will be transferred to PL. Now remeasurement reserve as per Ind AS 19, it says it is not reclassified to PL. So it will be transferred to retained earning. Correct? Equity investment FBOCI for that Ind AS 109 say it will not be reclassified to PL, so it will be also transferred return earning. And FCTR as per Ind AS 21, Ind AS 21 say it will be reclassified to PL, so this will be transferred to PL. So can you say for that we need to do as per the requirement of other Ind AS? For that we need to do as per the requirement of other Ind AS. Got this point? So this will be generalized closed as per respective Ind AS. Now we can pass the journal entry for loss of control. That is very easy. Come to the loss of control journal entry. So what will be journal entry? Already I have the solution. No, I don't have. So let me do the journal entry. What journal entry will do? First journal entry what? First journal entry what? Can you say bank account how much we have received? So 70% has been sold and 56 crore has been received. Investment how much retained? 20% retained, and that is how much? I think 16 crore. It is 16 na? No. Yes, it is 16 crore. Then NCI is 10%. So 10% of what? 10% of INA 60. So it will be 6. Correct. 2. Net asset is how much? Net asset de-recognized, that is 60. If goodwill is not given separately, so we'll assume net asset is inclusive of goodwill. Okay, sir, it is full goodwill. Okay, sir, yes, sir. Correct. Now difference will be gain or loss. So how much gain, how much loss? That is 56 plus 16 plus 6 minus 60. You can see 18. So 2 gain, and this gain will be transferred to PL. How much? 18. Okay, sir. Then we'll pass the corresponding journal entry for OCI component. So first is what? FB-OCI reserve for the debt instrument. That will be reclassified from OCI to PL. So what journal entry will do? OCI, FB-OCI reserve account debit to gain, and this gain will be also transferred to PL. What was the amount? 90% was how much? 5.4. So we'll do 5.4. Understood? Next was a remeasurement loss. The remeasurement loss as per Ind AS 90 will be transferred retained earning. So what journal entry will do? Retained earning account debit to remeasurement reserve. Because it is a loss will be debited retained earning. What was the amount? Amount was how much? It was 2.7 crore. Okay, sir. The next 1 second is the equity instrument through OCI. That will be also not reclassified to PL. So what journal entry will do? Next journal entry is FB OCI reserve account debit to retain earning. What is the amount? Amount is what? That is 3.6. And last one is what? FCTR. That will be also reclassified to PL. That is OCI FCTR account debit to gain, and this gain will be transferred to PL. That is 7.2. So suppose in the exam they ask you what is the impact on PL. The impact on PL will be what? This is 18 plus 5.4 plus 7.2. And impact on retained earning is what? 3.6 minus 2.7. So this type of question can be asked in MCQ also. So you can answer accordingly. Okay, sir. Now it is through RTP it has been understood that now they can ask this type of question, because in RTP similar question has been given. Okay, sir. Not exactly this, but similar question has been given. Any doubt? Bolo. Chalega. This also done. Now come to the next question. Next question is 41. The last question of Ind AS 110. 41. What is 41? Let us check. Now 41 is a question of chain holding. Let us do that also. The previous CBS as on 31st March 2002 of a group company comprising P Limited, S Limited and SS Limited. So P, S, SS. Balance sheet is given. You can see P has invested in S how much? 340 lakh, and S has invested in SS 280 lakh. Okay, sir. Then you can read. Then they give bill payable PSS. You can see this 70 and 30 will be cancelled. So this 70 will be cancelled and 2 will remain in the balance sheet. And this 30 will be totally cancelled. Totally cancelled. Okay, sir. Yes, sir. The following additional information is available. P Limited hold 80% share in S. S Limited holds 75% share in SS. Their holding were acquired on 30th September because it is same date of acquisition. So in this case, we'll prepare 2 AOP, 2 SONA and 2 Goodwill and 2 NCI working note. Everything will be 2 to 2. However, in this case, the same date of acquisition, it can be different date of acquisition also. The different date of acquisition, so do as in the same way, but can I say in one SONA, means in one AOP or SONA, the date of acquisition will be different. In other AOP and SONA, date of acquisition will be different. Only that is the difference. However, the entire question, entire solution remains same. The business activity of all the company are not seasonal in nature, and therefore it can be assumed that profit are evenly earned, but it is a general assumption. On 1st April 2000, the following balance, of course, they have given. Rupees 10 lakh was included in the inventory figure of S Limited. Is the inventory which has been purchased from SS at a cost of 25%. The sale of goods by SS is done after the acquisition of shares by S. So can you see it has been sold by SS to S, so it become an upstream transaction. Upstream transaction. So upstream transaction means what? There is a profit of SS included in the stock of S. Correct? Understood? And eventually in the stock of P only, because stock of S will become a stock of P. Are you able to understand? So this become an upstream transaction. So either this URP, you can do directly adjustment in AOP, or you can do adjustment with what? The retained earning NCI in the last working note. So I will say do with AOP because I think that is only you have done in the class. Okay, sir. But if you have forgotten AOP, directly you can do adjustment retained earning NCI in the last working note. Okay, sir. Yes, sir. The parent company has adopted an accounting policy to measure NCI at fair value, applying Ind AS 103. Assume market price of S Limited and SS Limited are the same as respective face value. Means face value and market price are same. So it means NCI will measure at fair value method. Super easy question. This question, same to same question have been asked 3 times in exam, but in the recent time they have not asked. So highly expected question this time. Highly expected. Why? Because in recent time they have not asked this question. Okay, sir. Okay, sir. Chalega. So in this, the main working note is what? Which I am supposed to inform you is about NCIs here. Is about NCIs here. 1 minute. I have the solution. You can see. Question 41 we are doing. First adjustment is what? First, calculation of NCI. Calculation of NCI. Okay. NCI here. So in this, first write on S, SS, total holding 100. First write on minus direct holding. So direct holding in S is 80%. And can I say there is an indirect holding of parent company in SS? Because parent company is holding 80% in S and S is holding 75% in SS. So can I say parent is holding how much share in SS? So that is 80% of 75%. Means if it is parent S, SS. S is holding 80%, P is holding 80% S and S is holding 75%. So what is the share of parent company in SS? That is 80% of 75%. Am I right or not? So that become 80% of 75%, that is 60%. Therefore, NCI in SS will be 40%. NCI in S will be 20%. This is the first major working note. If you have done mistake here, entire solution will be wrong. Okay, but not difficult. Understood? Yes, sir. Then second, date of acquisition. Okay, you have understood date of acquisition. Both same date of acquisition, so 6 months, 6 months. Then can you say we'll do 2 AOP, 2 SONA and 2 Goodwill calculation. AOP is very easy because there is no adjustment. No adjustment. So you can see this is closing balance given, opening balance given. This will be allocated in pre and post acquisition profit. In 6 months that is allocated, and the opening balance will be added to pre acquisition profit. This become allocation. Same thing will do for SS Limited, because there is no adjustment, no dividend paid, no bonus shares, no abnormal loss, no error. So nothing has been given. So it becomes super easy now. So always find out whether this 4 adjustment given or not. Dividend paid, abnormal loss, error, and bonus. If nothing has been given, super easy, you can do it. Then Sona Best Limited, because there is no fair value adjustment also. So since fair value adjustment information is not given, it becomes super easy. So this is the equity share capital. Then other equity, you can find out this. This you can allocate in the respective parent company NCI share. So for S it is 80% and 20%, and for SS it is what 60% and 40%. Already we have worked out that we can work out. Yes sir, up to this, so no doubt. Then we'll do goodwill. Now, how to calculate goodwill? This I need to explain. Goodwill and this working note, these are the two major points. Now, whenever we are calculating goodwill, for S, PC will be what? As per the cost price of investment, whatever has been given. But PC for SS will be, because can I say, the PC of SS means PC for SS. So actually this we are doing consolidation from parent company point of view. So you just need to understand how much S has paid to acquire SS from the point of P. Are you getting what I am saying? So S has paid 280, but in this 280, how much is the parent company share? That is 80%. Means S has paid 80% of 280 to get control over SS, and therefore PC will be 224. So it will be 80% of 280. 80% of 280. This is the major point. Got this point? Have you understood this point? So just think in this way. In S balance sheet, means in S balance sheet there is an investment of 280. Means S has paid 280 to gain control over SS. But how much S has paid on behalf of P? So S has paid 80% of 280 on behalf of P to gain control over SS. This is the concept. Yes, sir. Now, fair value of NCI, you can find out. The fair value of NCI will be what? We need to find out the total number of shares not held by parent company. So for S, it will be 20% of total number of shares. For SS, it will be 40% of total number of shares, and multiply with the fair value of equity shares. So they have given fair value is equal to face value, and this you can work down. The total will come minus fair value of INA. This will be goodwill. Means this is the gain on bargain purchase. This is also gain on bargain purchase. This become total gain on bargain purchase. Okay, sir. So in this is the major point. Have you understood this point? Now coming to other equity. Other equity will be also easy. Other equity will be also easy. So this balance we have taken from what? Parent company balance sheet. This balance we have taken not to NCI. So this NCI in S, NCI in SS. So this balance we have taken from previous working note, that is goodwill working note. Okay. Now can you say sharing profit? So sharing profit of S will be allocated. So sharing profit of S will be allocated in 80 to 20%, and sharing profit of SS will be allocated in what? In 60 is to 40 ratio. That allocation you can do. That is not a point of discussion. You can see URP I have deducted from here. With this URP, because upstream you can deduct from AOP also, or if you have forgotten there, because normally what I think is sometime AOP adjust, sometime URP adjustment, unrealized profit adjustment, you might forget from AOP. So if you have forgotten from there, because this is unrealized profit due to upstream transaction, so this belong to this unrealized profit, means profit of subsidiary company belong to parent company and parent company NCI. So you deduct from parent company NCI here. Now this is URP of SS. URP of SS means what? 60%, 40%. So you can say 60% I have deducted from this, 40% I have deducted from SS. So this become final answer. Correct. Now last adjustment is what? That is thoda sa. Now everyone are able to listen me? Now everyone, your little technical issue. Now everything is fine. Okay. So what I was explaining about NCI share in investment in SS Limited. You can see while calculating Goodwill, we have taken only 80% or 280. Means how much we have not taken 20% or 280, and that is nothing but NCI share. So that NCI share will be deducted from NCI in subsidiary. Subsidiary means S. SS means sub-subsidiary. So what we'll do in NCI and S, the 20% of 280, whatever was not considered while calculating PC, will be deducted from this. This right now, to only understand this particular adjustment, the 20% of 280 will reduce from NCI in S. Okay, sir. And this will become your final NCI, that is 29 plus 137.20, that will come in the balance sheet. This is the one major adjustment. So there are 2-3 points. If you have understood that, the chain holding is very, very simple. Chain holding is very, very simple. Understood? Chalega? Yes, sir. Bolo. This also done. After that CBS, you can prepare CBS in that, no doubt. You can see all expected question of consolidation chapter. I have means of Ind AS 110. Abhi I will take some question for Ind AS 28 also, but I have taken all the expected question of Ind AS 110. Now, if you have any question in your mind, you just inform me. We'll take that question. Otherwise, I'll move to some other chapter. Bolo. Any question you have in your mind? Any concept of consolidation? Any concept? Only one point I just want to inform you about bonus share adjustment if the journal entry has been done. If suppose bonus share journal entry has been done, then what you will do? So while doing analysis profit, what you will do? Suppose you have taken retained earning and general reserve. First you write down closing balance as per balance sheet. Then we write down opening balance as per additional information. This will be the profit after bonus shares. And normally in the question they will give, if bonus share has been given, it has been declared out of general reserve. So what we'll do, we'll add back bonus share. We'll add back bonus share in general reserve. Okay. So this will be the profit before bonus shares, and this too will be allocated to pre and post acquisition profit in time ratio. It will be allocated to pre and post in a time ratio. In this we'll add opening balance. Opening balance will be added to pre, and from this we'll do minus bonus share again. Minus bonus shares, and bonus shares will be deducted. Bonus shares will be deducted always from pre-acquisition. Always. Normally it will be given the question, even the question silent, bonus share deduct from pre-acquisition general reserve. Pre-acquisition general reserve. So this will be your final answer. This will be your final answer. Understood adjustment? If the bonus share journal entry has been done, so first add and then minus always from pre-acquisition general reserve. Pre-acquisition general reserve. Okay, only this much. Only be careful about one point. whenever they have given final dividend, so final dividend, suppose 10% they have given, so 10% of capital, it should be capital before bonus shares, before bonus shares. So be careful about that. Okay. So if suppose the balance sheet, the capital is coming after bonus share, so you need to first convert the capital into before bonus share and then calculate final dividend. Okay. And also in calculating holding ratio, be careful. So whenever bonus share adjustment or journal entry has been done, be little careful about that particular point. If you have understood whatever I have said, you will be able to do it. Okay, sir. Question number 62, dividend adjustment. Question number 62. So 62, whether it is in my expected question? 62, whether it is in my expected question? No. You want me to take 62? This question 62 is of what? My question bank you asking? Question 62 of what? I think he or she is asking about my question bank. Let me go to the question bank. I think you are asking about this question. This question, am I right? Okay, chalo. The balance sheet of H Limited is given. You can see in this question they have given dividend payable 400, and dividend payable by subsidiary company will become dividend receivable in the parent company balance sheet. You can see dividend receivable is coming also 320, and because they have acquired 400 lakh shares, so 400 lakh shares out of 500, it is out, sorry, they have acquired S Limited 400 lakh shares of rupees 10 each, correct? So H Limited acquired, sorry, H Limited acquired 80%. So 80% of 400 is how much? 320. It is correct only. Now C has asked, I think, the adjustment for this dividend payable. Now normally students are confused about this point. Dividend payable represent the dividend declared out of pre-acquisition profit. Don't be confused about this, because just try to understand dividend payable. If it is final dividend, it is always declared out of previous year profit. So final dividend of, if the final dividend, if that is declared in current year, that is declared out of current year profit or previous year profit. Previous year profit, so final dividend is always declared out of previous year profit. And this question, previous year profit is pre-acquisition profit. So this sentence is correct. Means this sentence is informing you that it is a final dividend. It is not the current year interim dividend. I hope you are understanding whatever I am saying. Got this point? And you can see they have acquired on 1st April. So the date of acquisition is the beginning of current year. Now what you will do? You need to find out retained earning. And they have given only retained earning in this question. Am I right? Yes. So 5,000 is the closing balance. Then opening balance how much? Opening balance they have given how much? 3,000 lakhs. So 3,000 is the opening balance. It is 2,000. They say final dividend payable, because journal entry has been done. So 400. This become 2,400. I think there is no other adjustment now. Just check it. There is no other adjustment in this particular question. Yeah. So this is the profit. This will be allocated in pre and post. And this will be entirely post 2,400. And this will be what? Pre. Okay. Now from this, you will minus final dividend again. Now this final dividend payable, because it is not yet paid, so it will be paid, means it is not yet paid. So can you see, it is post acquisition period only, means it is not paid during pre-acquisition period. Got this point? They have deduct from what? Post acquisition only. Got this point? This is the point, because it is not paid during pre-acquisition period. So it is not paid during pre-acquisition period. It is a liability of post acquisition period only. Got this point? So deduct from post. So this become 3000. This become 2000. Understood? Have you understood this point? Bolo. Have you understood this point? Jan Janani. Janani. Have you understood? Janani or Janani? I'm not able to understand what is the pronunciation. But have you understood this? Yes, sir. Balance you can do. I hope it will be simple only. In the TBS, can you see this 400 and dividend receivable 320 will be cancelled and 80 will remain in the balance sheet as a dividend payable to the extent of NCR share, and that will be shown under current financial liability, other financial liability, current other financial liability. Okay, sir? Yes, sir. Chalo, done. Now coming, I will take a small break. After break, we'll come back and we'll do one question of Ind AS 111 and two question of Ind AS 28. Then consolidation chapter will be over. Okay. Now, everyone, can we again start? Yes, sir. Now come to India's triple one. And there is only one question which is expected from my point of view, question number 8. However, the other question is also important, but I am expecting question number 8, which is very good question. What they have given, entity A and entity B establishes a 50:50 joint operation in the form of separate legal entity. Entity J, whereby each operator has 50% ownership interest and take 50% of the output. So entity J is a joint operation. On formation of joint operation, entity A contribute a property with a fair value of 110, an intangible asset with a fair value of 10 lakh, whereas entity B contribute equipment with a fair value of 120 lakh. The carrying amount of these assets contributed by A and B are 180 lakh respective. What amount of gain or loss we recognize the entity A, entity B in its separate financial statement as well as consolidated financial statement? That is the question. It means first we need to understand what actually the question want to say. You can see entity A, entity B. This is entity J, means joint operation, 50%, 50% interest is there. Now you can see the entity A has contributed two assets whose fair value is 120 lakh and carrying amount of that asset is 100 lakh. And entity B has contributed asset whose fair value is 120 lakh and the carrying amount is 80 lakh. It means just try to understand whatever asset has been contributed by A, can you say 50% is transferred? For this 50% is transferred and for this 50% is received, correct? So can you say whatever the asset, whatever the contribution by B, in that A will get 50%, right? Yes or no? And for that we'll consider fair value of that asset. So for A, what we'll do, fair value of asset received is what, 120, 50%. To 120, 50% is 60. And can you say whatever asset has been transferred, for that we'll say carrying amount of the asset transferred, that is de-recognized. So carrying amount is what, 100. So 50% de-recognized. So minus carrying amount of asset contribute, that will de-recognize. So for A, it is 100 into 50%. So gain is what? Gain is 10. Understood. Similarly, for B, can you say we'll take fair value this 120 and this is the fair value of the asset received, correct? For B, so it is 120 into 60%. And the carrying amount of this has been transferred to 50% of 80 lakh, that is 40 lakh. You can say gain is 20 lakh. Gain is 20 lakh. This is the question. Understood? Very simple. can be asked in multiple choice question. Can be asked in multiple choice question. Let me explain this scenario as 60 is to 40. So because that is 50-50 ना, तो confusion हो रहा है. Correct. So if I explain from 60 is to 40, so what actually happened? A joint venture B. A has transferred, B has transferred. This is fair value 120, carrying amount 100. This is a fair value 120, carrying amount 100. Now A has received this, so 60% of this has been received, and A has transferred this, so 40% of this will be recognized. So in this case, the understood, 40% of this has been de-recognized. So you can say gain become what? 72 minus 40. Are you able to understand what I am saying? So receive means 60% received. Transferred means 40% transferred. 40% transferred to other joint operator. Got this point? So now it will be more clear. Now for B, it is 40% of this has been received and 60% of this, 60% of this was 80, my mistake. 60% of these will be de-recognized. 60% of this will be de-recognized. Understood? I think you have understood now. So when it is 60-40, you will get more clarity. 50-50, a lot of confusion is there. In which 50 we are saying. Token is if for A, 60% will be received and 40% will be de-recognized. 60% of asset will be recognized. 40% of the asset, whatever has been contributed, the carrying amount will be de-recognized. Got this point? Simple. Understood? Yes, sir. Now let us come to Ind AS 28. In Ind AS 28, we have two questions. Question 5 and 61. Come to Ind AS 28. Coming to Ind AS 28. Yes, sir. The first question of 5. Come to question 5. This is one of the favorite question. Normally, either in MCQ they can ask or in descriptive question also they can ask. On 1st April 2019, Investor Limited acquired 35% interest in another entity, XYZ Limited. Investor determined that it is able to exercise significant influence over XYZ Limited. Investor has paid total consideration of 47,50,000 for acquisition of interest. At the date of acquisition, the book value of net asset is 90 lakh and the fair value is 1 crore 10 lakh and the difference is 20 lakh pertain to the item of PP, which has a remaining useful life of 10 years. It means there is a fair value gain of 20 lakh. On that, additional depreciation will be how much? Additional depreciation 20 lakh divided by 10 will be what? 2 lakh. So additional depreciation will be 2 lakh. During the year, XYZ Limited made a profit of 8 lakh and paid dividend of 12 lakh. On 31st March 2020, X Limited also had long-term investment in equity securities and the Ind AS investment was classified as FBTOCI and XYZ Limited recognized increase in the value of investment 2 lakh in OCI. So there was an OCI gain also. Ignore deferred tax implications, calculate a closing balance. So first we need to find out goodwill. So how to calculate goodwill? Batao. Okay. So can you say goodwill will be first calculated okay, I don't have the answer. So goodwill, okay, so goodwill, how you will calculate? First you will find out PC 35%. What is PC? 47,50,000. 47,50,000. And what is the fair value by INA? 1 crore 10 lakh. So 1 crore 10 lakh into 35%. How much? That is 38 lakh 50,000. So what is the goodwill? Goodwill is how much? Batao. Goodwill is equal to what? 9 lakh. So 9 lakh become goodwill. 9 lakh become goodwill. Okay, sir. Means the cost price of investment will be including goodwill and this goodwill will not be separately recognized. Yes, so because it is already included in the carrying amount of investment. So what is the cost price? 47 lakh 50,000. Correct. Now what is the profit? Profit 8 lakh of associate. In this 8 lakh, yes, we will do fair value additional depreciation adjustment, that is 2 lakh. So 8 lakh minus 2 lakh, that is 6 lakh. So 6 lakh into what? 35% how much? So 2 lakh 10,000 will be added. 2 lakh 10,000 will be added. Then 12 lakh dividend paid. So that 35% received, that is deducted from the investment only. So 12 lakh into 35% how much? That is 4 lakh 20,000 will be minus. So any dividend received will reduce the cost price of investment by 4 lakh 20,000 in this question. Then OCI is 2 lakh. 2 lakh ka 35% how much? That is what? 70,000. So this 70,000 will be added, and therefore value of investment as per equity method will be 47 lakh 25,000 plus 2 lakh 10,000 minus 4 lakh 20,000, correct, plus 70,000. How much it is coming? 45 lakh. What is this? Some mistake we have done. 47 lakh 50,000 my plus 2 lakh 10,000 plus 70,000 minus how much? 4 lakh 20,000. It is coming 46 lakh 10,000. Exactly same. Correct answer came. Understood. So this type of question can be asked in exam. So in this case, only need to be careful about additional depreciation. Student do mistake there. So what you can see, the total profit is 8 lakh. I have deducted minus 2 lakh, and then 6 lakh at 35% I have done. Or you can do separately also, that is your choice. Okay. Then 70,000 in this two, no doubt. And of course, dividend received will reduce the investment. Means what generator will do? Bank account debit to investment. Bank account debit to investment. Okay, sir. I think no doubt about this. Then there is one more question, which is very good question, about question number 61. This is the first time this type of question was given in the exam, where they ask CBS and they are given H limited, S limited, and associate also. Correct? You can see, you can read the balance sheet. You can see H limited has invested in the 14,000 shares of S and 4,000 equity shares in A. Okay, sir. The following additional information is made available in respect of this company. H Limited purchased the shares in S Limited on 31st October 2003, when the retained earning of S Limited was full 5 lakh. When? Means can you say on the date of acquisition they have given retained earning? Means in this time adjustment is not required, because on the date of acquisition they have given retained earning, so time adjustment is not required. And the shares in A Limited were acquired on 30th June, when his retained earning was 1,75,000. For this also time adjustment is not required. Inventory of A Limited as on 31st March 2024 include inventory valued at rupees 60,000, which has been purchased from H Limited on 1st Jan 2024 at a cost plus 20%. So guys, this is inventory purchase from H, means downstream transaction. Whenever downstream transaction, then adjustment is done, and adjustment will be done through investment account as per Ind AS 28. Means in this case, what journal entry will do? Retain earning account debit to investment. Retain earning account debit to investment. Okay, sir. So retain earning will also decrease, investment will also decrease with the proportionate share in URP. Proportionate share means we need to find out how much share, what is the holding ratio in associate, means how much parent hold in associate, that we need to find out. Okay. Then trade payable of H Limited include 25,000 payable in A Limited, the amount receivable being recorded in the receiver A Limited. This is totally bakwas, because intercompany balance of associate will not be cancelled, because we don't recognize assets and liability of associate in the CFS of parent company. So this point number 3, ignore it. Goodwill in respect of acquisition of S Limited has been fully impaired. So of course you need to first find out goodwill, and that will be entirely impaired. The recoverable amount of investment in A Limited exceeded carrying amount as on 31st March 2024, means there is no impairment loss of investment. No non-controlling interest is valued at proportionate share in INA. So for subsidiary, NCI is measured by using Pasina method. 10% dividend was declared by both H Limited and S Limited, whereas A Limited declared 15% dividend for the year 23-24. 23-24 means it is actually current year only. Check karo, it is current year. It has been declared. On 31st March 2024, S Limited made a bonus issue of 1 equity shares for every 2 shares held by the shareholders of S Limited. Dividend were declared, but were not accounted for by all these companies in the books before they earn. Means they are saying that dividend declared, but no journal entry has been done. No journal entry has been done. Similarly, the bonus issue bias limited was not reflected in the balance sheet. So bonus here no journal entry, bonus here no journal entry, ignore it. So bonus here to no journal entry. Shortcut is what? Ignore it. So I think 3 times they have asked question of bonus here in exam, and all 3 times they have given bonus here journal entry was not made. If the bonus here journal entry is not made, it becomes super easy question. So be careful. I think in the next time they may ask bonus year journal entry has been done. Already I have informed you about bonus year journal entry has been done, then what adjustment you are supposed to take. Got this point? Any doubt about this? No. Okay, sir? Yes, sir. Only for this point number 5, because it was not clear. Just try to understand what they have said. Dividend were declared for the current year, but they have not given the question this is final dividend or interim dividend. Just try to understand. Interim dividend of current year can be declared in current year and paid in current year. Okay? But final dividend of current year cannot be declared in current year. It will declare after balance sheet date, after reporting date. So actually from this particular question point, there were 3 assumptions available. Out of that, I will say whatever assumption has been taken by ICAI, the last assumption was the Bakwas assumption. I will say 2 assumption is appropriate. First assumption is what? If this dividend is actually declared after reporting date, then no adjustment required, no entry, ignore it. So if you have taken that assumption, super easy question. So if you have taken one assumption that this dividend has been declared after reporting date, then no journal entry, no adjustment required. But suppose if you assume it is interim dividend, so this will become interim dividend declared but not paid. Declared but not paid. Are you able to understand what I am saying? Declared but not paid. So that is the one assumption which will be, for which the solution will become more interesting. And what I have seen in the this time RTP same question was given, and what I remember, I think they have modified a question. I have remember they have modified a question, and I think in that question they have mentioned that this is a dividend declared but not paid. So can you see, if it is interim dividend declared but not paid, then what will be the adjustment? So we'll assume, means I will just explain from the point of view, because if you take assumption that this is the dividend declared after reporting date, then it becomes super easy. So what assumption I will take? Suppose in the question, in your exam question, they have mentioned this is the interim dividend declared but not paid, then that becomes interesting point. Correct now? Interesting point. So what will assume? This is interim dividend declared but not paid. So it will become payable. It will become payable. And for the receiving company, it will become receivable. For receiving company, because if it is declared by subsidiary company, it will receive by parent company. If it is declared by associate company, so then also received by parent company. Okay, sir, this point become interesting. We are required to take note of the above available information. You can see in this state, the assumption they have given. I will take this assumption. Consider dividend was declared but not paid. This assumption I will take. Okay, sir. Chalo. Can I explain from this assumption point of view? We have question number 61. 61. This is the question. Yes, sir. First, we need to find out the holding ratio. So holding ratio they have not given. So let us find out. To 14,000, because once again bonus year journal entry has not been done. So very easy. So 14,000 out of what? 20,000. So 14,000 out of 20,000 means 70%. This is 70%. And 4,000 out of 10,000 means this is 40%. So you have got the holding ratio of parent company. Okay, sir. Now first we'll do what? Fair value adjustment, but there is no fair value information given. As a first think only about subsidiary company. Then we'll think about associate, because for associate to Ind AS 28 will be applicable. First think only about subsidiary company. So there is no fair value adjustment. Let us do AOP. So AOP, can you say closing balance given? Opening balance given? Correct. Okay, this is the profit. Now only how many adjustment given? Dividend? Yes, one adjustment. Bonus here? Ignore. There is no abnormal loss, there is no error. Dividend, but dividend is declared but not paid, to this become dividend payable but not recorded. So if dividend payable is not recorded, the question of nullifying it will not arise. So I am writing plus dividend payable, but because not recorded, so no need to add back. If it is recorded, so we'll add back. As some question, one question I have done 62 as per your demand, in that it was recorded, so we have added, but here it will not be added. So this will be 2,50,000. Then this will be allocated to pre and post acquisition profit. So what is the date of acquisition? Because can I say this retained earning, this has been given on the date of acquisition only. So entirely will be post. This will be entirely post. And opening will be entirely pre. Now minus dividend payable will do. So minus dividend payable from post only. So always dividend payable will be from post. So minus dividend payable will be from post. This become 5 lakh and this become 2,30,000. Understood this point? First point, have you understood? Bolo. Any doubt? So dividend payable, it become liability of post acquisition period. Therefore, deduct from post acquisition profit. Okay, sir. Okay, sir. Yes, sir. Now, can you say we'll do Sona of S Limited date of acquisition, date of consolidation. So equity share capital is given and other equity already we calculated, that is 5 lakh, 2,30,000 and this. So this calculated, this will be allocated in 70:30% because there is no fair value adjustment. Super easy. Then we'll do goodwill or gain or bargain purchase. Goodwill or gain or bargain purchase. So 70% PC, it is already given the question. PC, it is already given the question. 5,60,000 it is given. We have taken this 5,60,000. Then NCI will measure by using Pasina method 30% of this 7 lakh, 30% of this 7 lakh. Already we have calculated 7 lakh, 2,10,000. Then minus what? Fair value of IN is 7 lakh. So 70,000 goodwill and it is given. It is entirely impaired. So entirely impaired because this is Pasina method. Therefore, partial goodwill, this impairment loss will be entirely attributable to parent company. Got this point? Yes, sir. So carrying amount of goodwill will be 0. Now can you say we'll apply, because once it has been calculated, now we'll do investment accounting as per equity method. Means investment associate as per equity method. First, so can you say we need to find out goodwill or capital reserve on the date of acquisition. Goodwill or capital reserve on the date of acquisition. So what I will suggest, for that also you calculate AOP and SONA for your benefit, okay. So AOP, you can see closing balance given, opening balance given, dividend payable, okay, understood. Now in this also this entire, because dividend payable not yet recorded, there is no need to add back, so this become the profit and this is entirely post acquisition profit, and the pre acquisition profit is the opening balance. But from this, whenever you are in equity method, don't deduct dividend paid or payable, never deduct. That I have explained in the class. Because this dividend payable, why will not deduct? Because will not deduct as share in profit, and dividend will be adjusted separately in investment account. However, you can deduct also. Then be careful, then net adjustment will do. Correct now? So if you can deduct also, but then you need to be very much careful. Okay, sir. Yes, sir. Understood. And can you say this always calculate profit before dividend? So I said this will be always profit before dividend for equity method. But if you want after dividend, that is also correct. Nothing to worry about that. But in that case, you need to be थोड़ा सा conceptually clear. Okay, sir? Yes, sir. Then once again we'll prepare SONA. So this will become equity share capital on the date of acquisition. Then this become other equity as per previous working note, and this 2,49,000, 40% will be 99,600. So this is share in profit. Now we'll calculate goodwill or gain. The cost price of investment is 1 lakh and 40% of 2,75,000 will be 1,10,000, and this will be what? Your gain, and that will be transferred to capital reserve. Understood? Are you able to understand? Yes, sir. Correct. Now we'll find out investment account as per what? Equity method. So what is the cost price of investment? 1 lakh. we'll add gain, that is transfer to capital reserve. This will become 1,10,000 on the date of acquisition. Now we'll do sharing profit. Already we calculated 99,600 and then minus dividend receivable. This was the point, because we are habituated of deducting dividend received. Dividend received or receivable. So dividend receivable, what journal entry? Dividend receivable to investment account. Correct now. So if you are deducted from this, then it will automatically net amount. Then you will forget about dividend receivable. So what journal entry we are doing here? Dividend receivable to what? Investment account. So that dividend receivable will come in the balance sheet. Dividend receivable will come in the balance sheet. Understood? 6,000. And the last point is what? URP, unrealized profit. Already I have said that will be also adjusted with the investment account. Journal entry will do return earning to investment account. So what is the unrealized profit? Let us calculate. So what they are saying? Inventory in A Limited includes 60,000 which has been purchased from H Limited at a cost plus 20%. So this 60,000 into 20 divided by 120, that is 10,000. 10,000 of 40%, how much? 4,000. We can see we have done adjustment with 4,000. So 40% of URP, 40% of URP, that will be also adjusted with retained earning. So this become value of investment as per equity method. Have you understood this point? Bolo. Have you got this point? Yes, sir. Now, other equity in NCI, this is also simple. So, retained earning as per the parent company balance sheet, NCI as per previous working note. Then, sharing profit from S company from Sona already we calculated. Correct. Then, can you say this must be understood? Now, there is one dividend payable by parent company. So, dividend payable by parent company will be also reduced from retained earning. Means what journal entry will do? Retained earning account debit to dividend payable. Correct. So because that is also not recorded, because all company has declared dividend. All company has declared dividend. So H Limited, whatever dividend declared, the journal entry will be retained earning to dividend payable. That we have deducted. Okay, sir. Yes, sir. Yes, sir. Understood. Now, can you say whatever dividend payable has been declared by subsidiary company, that will be received by what? Parent company, and that is also not recorded. So one journal entry will be done by parent company. Dividend receivable to retained earning. So dividend receivable to retained earning, that will be added. So you can see the total amount of dividend payable by subsidiary company was 20,000. Out of that 70% receivable. So 70% will be added. So this too was actually error in the books of parent company. Error in the books of parent company, and therefore adjusted with retained earning. Correct. Have you understood this point? So dividend payable by parent company and dividend receivable from subsidiary company, that is also done. Got this point? Have you understood? Dividend receivable from associate company will be adjusted not with retained earning, that will be adjusted with investment account, and that is already done. That will not come in retained earning account. Yes, sir. Yes, sir. Then sharing profit from associate. Then share in URP. And there is one impairment loss entirely attributable to parent company. So entire amount, this total will come, which is the final balance in CBS. Understood? Correct? Understood. Now in CBS, only be careful about 2 points. Just try to understand. In CBS, I think all points will do. In CBS, I just want to explain one point. Just try to understand. When you prepare balance sheet, so dividend receivable will come. So one is what? Dividend receivable from subsidiary company. How much? 14,000. One is dividend receivable from associate, that is 6,000. And that is one will be dividend payable. Dividend payable by parent company. How much? That is 50,000. And dividend payable by subsidiary company, that is 20,000. And dividend payable by associate will not come, because assets and liability of associate will not be recognized. Correct? But out of this 14 will be cancelled. So 14,000 will be cancelled, because this will be intercompany balance. This will be cancelled. The dividend receivable will be 6,000, and this will be 50 plus 6, that is 56,000. This will be the final balance of dividend receivable and dividend payable. This have you understood? Have you understood this point? Apart from this all balance you can write down. I think this was the point which was interesting. Have you understood this point? Bolo. Have you understood this point? I think you have understood. Chalega. With this all the questions we have done of consolidation chapter. Okay. Okay. Now what I have decided, okay, because I have understood that most of the students you are just seeing offline. Correct now. So what I will do, the business combination chapter and financial instrument chapter, I will record and upload. Okay, because what happen if you are not, if you are, I am taking live class and if you are not coming on time, you are not responding on time, this will not be interesting. Correct now. Okay, that is a point to understand. So business combination and financial instrument chapter and all other chapter which I think are important from your point, I will record and upload so that whenever you have time, you can listen it by your own. So consolidation we have done today. I hope you have understood this. Any doubting consolidation question, whatever you think, just inform me. I'll wait for 2-3 minutes. Okay, so today this much only. And for business combination and then financial instrument chapter, I will try to upload as soon as possible. If any other chapter you think the expected question need to be done, just message me in the comment box. I will take the expected question of that chapter. So I think today this is enough. And just inform me about how you have liked this particular session so that it will help me to understand what actually you require and what actually I am doing. Okay, sir. All the best for your exam preparation. Bye bye. Love you all.